Hello everyone. Today we'll be discussing about investing in stock. We all know that we started introduction to investments last week, and we talked about stock as one of the funds in which one can invest in. All right, so we're going to learn more about investing in stocks today. For the learning objectives, we'll try to learn how to invest in stock before we now move further to read stock quotes online. Furthermore, we'll try to understand how stocks are valued and what causes them to go up and down in price, because they are not usually stable, they go up and down. And thereafter, we'll try to employ different investment strategies, try to learn how to employ different investment strategies. And lastly, we'll try to understand the risk associated with investing in common stocks. As a form of introduction, investing in stocks is something that comes with its own risk, like every other form of investment. Like we usually say that there is no gain without pain, or no pain without gain. So when you are investing, you should also know that it comes with a particular kind of risk or different kind of risk. So investing in the stock market also is not without any risk, because you're also foregoing something. You are investing in some form of assets. You are foregoing your own liquidity for some form of assets. Investing in stock market is all about risk and return. So most times when the risks are higher, then there is tendency for the return to also be higher. So I think we discussed about that in the last class too, relating risk and return and the relationship. So we found out that, if you can recall, we found out that there is a positive relationship between risk and return, as the graph was positively sloped. So the risk at times is a pointer to your expectations when it comes to return. Then lastly, it's all about making a fortune. So for at times, investing in stock is all about making a fortune, because there are instances where you just make a boom of the sales of the stock like that. So depending on so many other factors, investing in stock can sometimes be a form of fortune making. Why should you consider stocks of all forms of investment? Why should you buy? Why should you consider investing in stocks? When you buy common stock, purchase a small part of the company. All right. When you buy a common stock of the company, then automatically you become part of the shareholders. All right. You become part of the company, and of course you also get returns. Your returns can be in the form of dividends. That is the company's distribution of profits to stockholders. Apart from that, you can also get return in forms of what we call capital appreciation, and this is where the increase in the selling price of the share, when there is increase in the selling price of a share stock. So if you, for instance, purchase maybe a share of a stock for a particular dollar, for example, maybe $2, and at the end of the day, the share appreciates, the share of the company appreciates, and maybe it's now sold for like $3 US. So it means that your capital has appreciated by $1 per unit of the share of stock that you have bought. So your returns also is very important consideration when it comes to investing in stock, because of these two points that have just been mentioned, as the dividends as well as the capital appreciation. Another reason you can consider, or you should consider, stock is that neither dividend nor capital appreciation is guaranteed with common stock. All right, when you are buying a common stock, both dividend as well as this capital appreciation, you should know that they are not automatic. All right, especially dividends, it's the board of directors who decide, right, what to pay. The dividends are paid at the board's discretion. For every company, they have a board of board of directors. So at the end of the day, once the profit is realized, they decide, right? They decide on what percentage of the dividends go to the different kinds of stock as well as the shareholders. Capital appreciation also takes place when the company does well. So it's not automatic as well that companies capital must always appreciate. So at times it doesn't. So you should also look at the performances of companies before considering which of them to invest in. Other consideration includes the fact that over time, common stocks outperform all other forms of investment. And apart from that, stocks reduce risk through diversification. You can, we talked about portfolio in the last class, right? So you can invest in different kinds of stocks. By so doing, you are diversifying, and when you are diversifying, you are also spreading your risk. You are spreading your risk, so the risk is limited. And apart from that, stocks are liquid. You can easily convert them to money. All right, if you need to be liquid, it's just a matter of consulting your agent, all right, and they help you sell some of your shares or all depending on how much you need, and then that's it. You are liquid again, so they can be easily converted to cash. Growth is determined by more than interest rate. So all these factors are what you can consider for you to be able to decide that okay, these stocks are worth investing in. So this is a graph showing the growth of $100 invested in different asset classes, like we mentioned before, that stocks allow you to diversify, and it's also allow you to spread your risk. When you are diversifying, you are spreading your risk. Like we have the different kind of stocks here that's on the New York Stock Exchange, the government bonds, treasury bills, as well as this one is the inflation rate. So all these three are the different forms of stocks that one can invest in. So here is a checklist of investment progress. So you can go through all this for you to be able to know if your investment is making progress or not. Is the return on my investment meeting my expectations and goals? Because don't forget that we mentioned also in the last class that you should have goals before going for investment. So as time goes on, you should also try to do an assessment of if that is being achieved, if your goals are being met with your investment. Is the investment performing as I was led to believe it would? Is the company making money? How is it doing compared to its competitors? Don't forget that we said capital appreciation really lies a lot on the company's performance. So this point is also very crucial. It's also very crucial. How much money will I get back if I sell my investment today? How much am I paying in commission or fees? Because you have to pay your agents too. Okay, you won't go to the floor of the stock exchange personally because you are not qualified. So it's those brokers that are qualified are allowed on the floor to trade, whether to buy or to sell. So you have to pay them commission, and that should also be considered too. Have my goals changed? If so, are my investments still suitable? In case you want to change your goal or you've changed your goal, are your investments still suitable to achieve those goals? So those are the things that you can consider. And lastly, what criteria will I use to decide when to sell? What do you want to consider? Do you want to consider maybe the capital appreciation, for instance, or maybe when you've had enough dividend according to your goals, or things like that. So these are factors for you to consider, or checklists for you to tick if you want to know how well your stock investment is doing. So here are some common language of stocks. They are just some terminologies that you need to familiarize yourselves with, really, or try to go through just a few of them. They've been explained in details in your textbook, so you can also refer to them. One of the common languages of stock or the stock market is the limited liability. The limited liability is a legal structure or form of legal protection that limits the extent of an economic loss or asset investment in an organization. So what it does is actually to protect the owner or shareholder from being personally liable, all right, from being personally liable or held responsible for their company's financial debt. For instance, if you've learned about the forms of businesses, you know that for a sole proprietor, their liabilities are not limited in the sense that when they owe or when they are in debt, they just have to look for means of the payment. Even their personal properties might be lost in the process, like might be used to rescue them or rescue the situation in the process. So for companies or for shareholders, they are protected by this limited liability to the extent that they can only lose what they have with the company in terms of the stock or shares. So they will not be personally responsible for any of the company's financial loss. For claims of income, this is the money derived from interest payments, dividends, or capital gain realized on the sale of stocks or other assets. So in relation to these claims of income, we have the declaration date or the ex-dividend date. The declaration date is the date which the board of directors of the company announces the next dividend payment. All right, they declare that, okay, we're going to announce the next dividend payment. So that's the declaration date. While the ex-dividend date is is an investment term involving the timing of payment of dividend on stocks of a corporation, income trust, or other financial holdings. So it involves the timing of payment of dividend or stocks of corporations. All right. The claims on assets, liabilities, and owners' equity. So these are some of the languages or terminologies that you have to familiarize yourselves with when we talk about the stock market. Another one is the voting right. This is the privilege or privileges granted to shareholders of a company to vote on the matters that affect the company. Like we mentioned before, that once you buy stocks, you become part of the company, you become a shareholder, you become part of the owners, so to say, of a company. So by proxy, your voting rights come with the privileges that is granted to you as a shareholder to vote, because normally when there are issues, perhaps maybe during the annual general meeting or something, the shareholders are entitled to vote on matters that affect the company. We also have stock split and stock repurchases. Stock split is when a company increases the number of its outstanding shares to boost the sales of the stock's liquidity, while stock repurchases is the company's use of shares. All right, share back buys, the buybacks, they buy them back, all right, to return profits to their investors. In addition to the earlier mentioned terms or terminologies, we also have what we call the book value and the earnings per share. Calculating the earnings per share, you have to deduct the preferred stock dividend from the net income, after which you're going to divide by the number of shares of the common stock outstanding. We also have what we call the dividend yield, the market to book or price to book ratio, which is calculated by dividing the stock price by the book value per share. And we have the classification of stocks. Some stock could be blue chip, some could be speculative, while some could be growing. So here are stock classifications. The blue chip stocks are stocks issued by large nationally known companies with sound financial history of solid dividend and growth record. The companies are already in existence and their performance is already known, all right? They are already known companies and they have history. They've made history over the years. The growth stock are common stocks issued by companies that have exhibited sales earnings growth well above the industry average, while the income stocks are common stock issued by mature firms that pay relatively high dividends with little increase in earnings. Apart from those three, we have the speculative stocks, which are common stocks that carry considerably more risk. We also have the cyclical stocks. These are common stocks issued by companies whose earnings tend to move with the economy. We have the defensive stock, which are common stocks issued by companies whose earnings tend not to be affected by swings in the economy, okay, whether there's recession or progress or whatever. And then we have the large cap, mid cap, as well as small cap stocks. These are classification of common stocks that refer to the size of the issuing firm. Moving on now, we want to talk about stock indexes and quotes. The stock market index is a measure of performance of a group of stocks that represent a market or a sector of the market. So the market index is not just about one type of stock or one company. So it's a measure of performance of a group of stock, all right, and they represent the market or the sector of the economy. For example, maybe the agricultural sector, okay, all right, maybe the transportation sector, things like that. So talking about those groups of stocks in the same market, that is what we call the stock market. And this is usually announced through the Dow Jones Industrial Average or Dow, and also the Standard & Poor's 500 and S&P 500 and other indexes. So there are many other indexes apart from these two that have been measured. The Dow Jones groups together the prices of 30 of the most traded stocks on the New York Stock Exchange, as well as Nasdaq. All right. So apart from these two common ones, there are other stock indexes or other measures of this stock market index. Talking about market movements, we all know that there is no market that is stable. It's either it is going up or down. The value of the shares is going up or it's falling. So market movement is the information that will cause any reasonable investor to make a buy or sell. Whether you want to buy or you want to sell, you only need to look at the market movement. And for this market movement, we have two of them. We have the bull market as well as the bear market. The bear market is characterized by falling prices, right? It's when we have a prolonged drop in investment prices, of shares. While the bull market is characterized by rising prices, which means that there is an extended period of time when stock price rises and investors are optimistic. All right. So depending on each individual investor, you have to look at this movement for you to be able to decide whether you want to buy shares, whether it's time for you to buy more shares or it's time for you to sell shares. So here is how to read online quotes. As I made this slide is quite tiny, so you have to go through this in your textbook. So all these indices and all these figures, they have their implication, which have been explained in the boxes. So you only need to go through each of them to be able to understand what they all stand for, or what each of them stands for. Valuation of common stock. How are these common stocks valued? The first is the fundamental analysis, and this focuses on such determinants as the future earnings and dividends, the expected level of interest rates, as well as the firm's risk. Those are the things that the fundamental analysis takes into consideration. Another form of analysis of valuing common stock is the technical analysis. And for the technical analysis, it focuses mainly on the forces of the demand and supply. All right, it focuses on the supply and demand of such stocks. We also have the earnings per ratio, right, or price earnings ratio. This is the indication of how much investors are willing to pay for a dollar of a company's earning. The higher the firm's earnings growth rate, the higher the price earnings ratio. All right. Higher the investor required rate of return, the lower the earnings per price ratio. So earnings per price ratio is also very important when it comes to valuing common stocks. Here is an image showing the average price earnings ratio of the S&P 500 since 1990. So another form of valuing your stock is to do the SWOT analysis, what we call the SWOT analysis. This analysis forces you to look both internally, all right, as a company, to the firm's strengths and weaknesses. You look at the weaknesses, you look at the strength of the firm internally, and when you look externally also, you see what are the opportunities as well as the threats. So SWOT is an acronym which stands for the strength, the weakness, the opportunities, as well as the threats of these stocks. So here is an image showing the SWOT analysis. Okay, looking at the company internally, you want to see what are the positive as well as the negative aspects. In terms of the internal positive, you have the strengths. All right, this is peculiar to the company. If it's internal and it's positive about the company, then those are the company's strengths. If it's internal but negative, then those are the company's weaknesses. The other aspect is the external aspect. All right, if it's external, if those issues are external to the company, if they are out of the company's control, for example, maybe government policies and other things like that. All right, so if it's positive, then they become opportunities for the companies to explore. But when they are negative and they are external, when the company have no control over them, when they are external to the company and they are negative or negatively affecting the company, then they become a threat. So this is how you go about the SWOT analysis. You try to see what are the strengths, what are the weaknesses, what are the opportunities, as well as the threats to the company. So these are the stock investment strategies. When you want to invest, what are the strategies? The stock investment strategies can use more than one of these approaches at once, right? We have the dollar cost averaging, we have the buy and hold strategy, as well as the dividend and reinvestment plans. So here is what to look out for when you have to invest. You have to be alert. Look out for recommendations from a sales representative based on inside and confidential information. All right, look for a representative that can give you inside information about the company. Then also you have to look out for telephone sales and sales pitches. Never send money to purchase a stock, right? You just have to, based on maybe telephone pitches or whatever. So you need to make it a more formal kind of investment. You also need to look out for representation of spectacular profits, such as your money will double in 6 months. You have to beware All right, if at times they may sound too good to be true. If an agent or a broker tells you this, then you have to look into it very well for you to be sure, so that you're not being scammed. Guarantees that you will not lose any money. When you are being guaranteed that you will not lose any money on any particular security transaction or an agreement. So all these are things that would give you they are like a red flag for you to be able to identify what's or when best to invest or what to invest in. Some may just be too good to be true, and some brokers would have quoted their tongue to the extent that you want to believe everything they say. But you still need to be alert and try to look at all these points critically before investing. We have the dollar cost averaging. Here, purchasing a fixed dollar amount of stock at specified intervals. So when you are using the dollar cost averaging approach, you purchase a particular fixed dollar amount of stock at some intervals, maybe every 3 months or every half a year. All right. The same dollar amount each period will average out the fluctuations in the prices of the stock. You buy more shares at lower price, or you buy fewer shares at higher prices, because all this will eventually fizzle out. So when the prices are lower, you can buy more. When the prices are higher, you only buy few shares. And then this dollar cost averaging keeps you from trying to time the market. Keeps you from trying to try the market. So here is the table showing the dollar cost averaging method. Here is the buy and hold strategy. That is another strategy that you can use apart from the dollar averaging approach. It involves buying stocks and holding it for a period of years before you now sell them off for your profit. It avoids timing the market, and it minimizes the brokerage fees and transaction costs, because the more you consult these brokers, the more they also charge you for commissions, all right, and other transaction costs. So it minimizes your brokerage fees, because you already know that you are keeping or holding those stocks for a particular period of years before you now sell them, okay, or do whatever you plan to do with them. And so within that time, you will have no reason to pay any broker for any transaction cost, because you will not be buying or selling during those periods. Then it also postpones capital gain taxes, all right. Capital gain taxes as long-term, they are also long-term capital gain. So these are the two strategies, the averaging as well as the buy and hold strategy. Then we also have the dividend reinvestment plans. These are the short form, or the acronym is the DRIPs. It automatically reinvests the dividend in the same firm stocks without brokerage fees. So rather than getting your dividends on your shares, what this does is to automatically reinvest it back in the firm stocks without any brokerage fees. You will not be charged any fees for such. So you use DRIP to reinvest rather than to spend your dividend. Rather than collecting your dividends and spending, you just reinvest them. You're still going to pay income taxes on these DRIPs, all right? And then you start investing in old companies instead of new. That's the implication, because dividend will be declared on the shares or the stock that you've already invested in. Okay, the shares that you've already invested in a company. So when you are reinvesting it, it means that it's still the same company that you are reinvesting in. You don't have to invest in a new company. As an investor, what should you know? All right, what should you know as an investor? One is value. It's very important for you to know. Okay, it's a good price for this stock. Is this a good price for this stock? You should be able to know the value of that stock before investing in it. Then the quality. Is this firm in a position that will allow it to be profitable into the future? All right, then you look at the strengths and weaknesses too. Okay, apart from the opportunities and threats, that's for the strengths and weaknesses. What are the firm's strengths and weaknesses, and are they likely to get better or worse? You have to be able to analyze that, and you have to be able to analyze the threats and opportunities too. What are these firms and threats and opportunities, and how likely are they to get better or worse? So an investor should be concerned about these factors: the quality, the value, the strength, the weaknesses, the opportunities, as well as the threats. Moving ahead, we want to talk about the risk associated with common stocks. Don't forget that principle 8 states that risk and return go hand in hand. So the more you invest, the more you are taking the risk, and then the more you are likely to get some dividend in terms of return. So they go hand in hand. The higher the risk, the higher the return. By diversifying your investment, you also minimize risk. That's another thing. You'll be minimizing risk by investing in different types of stocks or shares. So you're diversifying. So by that, you'll be reducing your risk or minimizing your risk. So here is a common graph showing the relationship between expected return as well as the risk. Don't forget that this is a positively sloped graph, meaning that there is a positive relationship between your expected return as well as the risk you are taking. So as the risk becomes higher, you see that the expected return becomes higher. All right. From this origin to this origin, of course, the risk is already constant for all the kind of stocks. So it's only when you move higher to higher levels that you'll be having higher expected returns. For example, you have US Treasury bills below here, moving on to commercial paper, long-term government bonds, long-term corporate bonds, as well as until we have the small company stocks. So as they go higher, the return will also continue to increase. So there is basically a positive relationship between the risk, the level of risk you are taking as an investor, and the level of return, the expected return afterwards. Another look at the principle 8, the fact that risk and return go hand in hand, all right, is one, beta. Beta is a measure of how responsive a stock or portfolio is to changes in the market portfolio. Don't forget that we mentioned that a market portfolio is a group of shares that belong to the same market segment or sector of the economy. So beta measures how one kind of stock is responsive to the changes in this market portfolio. Beta benchmark for market equals to 1. For betas that are greater than 1, the stock moves up and down more than the market. All right, and for beta that are less than 1, it implies that the stock moves up and down less than that of the market. So that's how you also assess your risk and return. So further, we have the short-term investment in stocks, which are very, very risky. You think that you just want to invest in stock for a short period of time, then it could be very risky, because it's possible that within that period the company may not even be doing well for you to be able to have maybe a capital gain, or at times it may not even be favorable at the end of the day. Maybe the value of the shares has dropped or something like that. So if it's just within a very short period, you may be taking more risk. Holding stocks longer reduces the variability of the average annual return. The average annual return will be affected. Investors can also afford to take on more risk as investment time horizons increase. They have more opportunities to adjust saving, consumption, as well as work habits. So when investing in stock, you should know that what is going to pay off at the end of the day is for you to give it some time to be able to appreciate. So you have to take that into consideration. So here is the range of returns on common stocks over 50 years. That's between 1954 and 2013. Sorry that this is even, like a decade ago, but then we have to stick to the data that are officially available. So far, throughout this lesson, we've learned that common stock over time outperform all other investments. We've also discussed the fact that stocks are liquid, as they can easily be converted to cash. We've discussed stock indices such as the Dow as well as an S&P 500 show. We mentioned the fact that common stock can be blue chip, growth income, all the different types of the common stocks. We discussed about them. We also discussed the fact that a number of methods can be used to determine the value of stocks, all right, but the interest rate, the risk, the expected future growth, and other factors determine the value of the common stock. We added the fact that you can use one or more investment strategies such as the dollar cost average, the buy and hold, as well as the drips. You can use one or more of these strategies when you are investing. And lastly, stocks are riskier, but diversification and watching better values can help. By the time you diversify in different stocks, then you will be spreading your risk. All right, and then don't forget that we mentioned about the better value. Okay, that which is greater than one, that which is less than one. So as an investor, you have to continue monitoring this for you to be able to make informed decisions. On this note, we've come to the end of our discussion. Thanks so much for your audience, and I hope to see you again in the next class. Thank you very much. Please do take care of yourself and stay safe. Bye.